Hello everyone, how's it going? In this video, we're going to talk about SOFI and the possible disruption to banks, its bullish phase, why people were interested in the stock, what happened that caused the deflation, and where do we go from there? So initially, people were interested in SOFI because it went public in an era where things were still on the up and up. People were hopeful about the future. And also, people were hopeful for the lone star of the financial sector almost, because very few fintech companies tend to do well in the market, unfortunately. So if we look at PaySafe, we can't say that it's been a stellar performance all the way, right? So this is why people who want to have exposure in fintech companies, they tend to go to the winners. And SoFi, for quite a few months, has been viewed as this famous winner of the sector. So that is for one reason. The other reason is because at some point it purchased a bank license, which allows it to conduct a lot of businesses that would require this kind of license. And the other thing is it wants to become like a sort of immaterial, intangible bank, which could disrupt the entire business. So that was before. That was then. What is now? The current situation is that the stock has now deflated to a much lower level, historically low, in fact. Its current level has been bounced off once before. And we can say that, yes, maybe in the short term, it's not going to test that level once again. But with the market where it is, this is only a scenario that's likely, or almost like a wish. It doesn't mean that it's necessarily going to hold there. Because if we look at what happened in the past, everything was possible, right? SoFi was able to hold around the $15 level for about a few months. It held there 3 times. But in the end, it still didn't hold that level and managed to fall down much, much lower. This is why I would say that SoFi overall is still largely dependent on trends. At the end of the day, my feeling is that a lot of people have been convinced by other people that things are going to be great and that things will continue to be great. And just like the real estate at some point, a lot of people thought that they're going to keep rising, rising, rising till the end of the time. This might be true in the very long term. So for example, over 30 to 50 years, a piece of real estate might increase its price. I'm not saying that it might necessarily increase its value, because that's another question. But its price is going to continue simply because the inflation has gone up. This may not translate very well with stocks, right? Because stocks could go to zero. The money in stocks can jump from one title to another in a much more flexible manner than with houses. So this is why I would say that with SoFi, we should be careful about the wishful thinking and how cheerful the people around us are. I was in this cheerful environment back in 2020 and 2021. What I can say is it's very difficult to separate what is true and what is complete BS. And you want to believe it. You want to believe that your skepticism is just like a little cynical man who should be ignored. Because no cynic has really succeeded in life, right? That's what you want to believe. In fact, things are much more gray. Things are much more nuanced. It's not because everyone believes something that this is necessarily going to be true. In my case, I wanted to invest into SoFi. It's just that at the time, I didn't have enough holdings, or rather, my portfolio wasn't diversified enough, and I didn't have enough money to put into SoFi. That was the sole reason why I've avoided the significant downfall. but it doesn't mean that this position isn't causing me some losses altogether. For example, right now I think I'm at a unrealized loss of 35 to 45% with my SOFI position. But because I literally have like below 10 shares of SOFI, it didn't really affect my portfolio. So this is what I'm trying to say. Like, when things are very great, be skeptical of why people are suddenly in that mood. And the same goes for when people are in the opposite mood, when they say that everything is finished, we're going to be done for another 10 years. Of course, be wary of that as well. Right now, SoFi is a good company. It has interesting services, it has, a professional website, and so on. So it is a decent company for its customers. But the question is, does it really matter for us? Us who may have our banking services already satisfied by other institutions, online, virtual, or brick and mortars. And for us, we need to make money with the stock going up, like higher than the cost that we bought the shares at. That is the fundamental thing. So can we do that at the moment? Probably not, unless you've scooped the bottom like about a month ago. This is unlikely, right? So this is why I think that it's going to be super relevant to look at the student debt situation. How much debt could be pardoned? How long will this program be left on? And what's going to be the landscape of the whole thing once this program ends, if it ends at all? So based on these, I would say that it's going to take some time to get back, and by time, it's measured in years, not even month. I think it's going to take a few years before SoFi goes back to its former glories. And of course, for the investors, my current suggestion, for those who already have SoFi stock, my suggestion is to either keep waiting or to buy in now with a very clear idea that you're not going to be holding for the short term only, that you're going to be in for the long haul. And because you're going to be in for the long haul, you would have to remember to try to suppress the urge to go all in at once and to try the dollar average down as much as possible over a long period of time. Because I don't think that SoFi is going to bounce back within a very short period of time, to be honest. I'm like 90 to 95% sure that SoFi is going to take years before it recovers. Do I think that it's going to recover? Yes. Like, if we talk about this without any sort of time notion, I think so. I think that SoFi is a well-run, decent business that can blossom in the long term. However, the momentum is now over, and we're not sure for how long that's going to last, right? We're not sure how long the bearish period is going to last. So this is why we have to be ready with a scenario that it's going to take a very long time. I would recommend a maximum exposure between 3 to 5% of your portfolio, and this assumes that your portfolio is already very diversified. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.